Hello, good afternoon and welcome to a Wealth of Advice market update recorded on the 25th of May 2022. We've got a lot going on here at Wealth of Advice at the moment. The next update that we're going to be sending to you will be about the new Wealth of Advice app that we're about to sort of talk to clients about and invite clients in batches to download the new app and start using. Hopefully you all find that as a real benefit. Over the past 2 years when we've been recording these client updates, once or twice clients have said to me that sometimes I've been a bit too cheerful and optimistic about what the future may hold. However, I will come back and say I always try and give a balanced view based on the information that we've been given to us from various industry experts, fund managers and such like. Over the last few weeks, we've had more fund manager presentations via Zoom, which is a great new addition, obviously since COVID. We get more access to fund managers. I've been to events up at Gateshead, up in Edinburgh even, speaking to various people. And the messages coming back to us are very, very mixed. There is very negative messages about what may happen in the coming months if the governments can't get a control over inflation. But kind of the big thing that was coming through was no matter what positive information seems to be given to markets right now, markets are reacting in a negative fashion. The big issue that you can highlight there is unemployment. Unemployment levels in the UK and the US are running at all-time low levels. However, that's been flipped to be a negative. Why is it a negative? Well, there's not enough people to fill the jobs that we have that are vacant. Therefore, the wages are going to go up because there's a greater demand for new employees. And when that happens, people's wages will go up. This comes, 2 years after I was reading articles saying that wage price growth over the last 10 years was the worst it's been since Victorian times and people were going to live in poverty. Well, you can't really win, can you? Because people are now earning more, and then the Governor of the Bank of England comes out last week and says that really people shouldn't accept a pay rise of more than 5%, because if you do, you're hurting the economy, because if you earn more, you're going to spend more. Clearly, the majority of clients who are watching this right now are retired, and guess what? You're also part of the problem, because an extra 500,000 people retired in the last 12 months than what the government were previously expecting. So whilst we're doing as best a job as we possibly can to help people retire sooner, the information that's coming back is too many people's retired, and as a result there's less people to fill up the slack and do the jobs. And this is the same in America, where I believe it's 10 times the problem, so over 5 million people retired sooner. So yes, as I say, it is time to be cautious, to be worried about what the future may look like. But there is definitely stories out there that we're listening and hearing to, which mean it shouldn't be all doom and gloom. Companies in general are doing good, so although interest rates are rising, people aren't not affording mortgage payments, getting houses repossessed, businesses aren't going bust. If you want to get a job, you can find a job. So it's not going to be like recessions, not like recessions that you had in the late 70s, early 80s, where there was mass job losses. People who want a job can get a job, but it's inflation that's the problem. It's not just inflation in the UK, it's in Europe, it's in America, it's in Asia, and a lot of that inflation is caused by what's happening in Russia and Ukraine. So in general market news around the world, the US stock market, obviously one of the biggest stock markets in the world, so important for everything else, that's teetering on what we would call a bear market. A bear market is where a stock market falls by over 20% in a given period. I think it got down to 18% falls from its highs in November in the last fortnight, and then big investors went in and bought the market to stop it falling below that 20%, so it couldn't be labelled a bear market. But like anything in life, what goes up must come down. We will live through times of bear markets. Similarly, we'll live through times of bull markets. What I would say is the bear market that we may be in at the moment, is if markets continue to fall, you would hope won't be one of the longest lasting ones, because the bull market we've just come out of, where markets increase year on year, has been one of the longest bull markets in history. And again, you would hope with what happens with world governments and stimulus and such like, that things will be done to make markets come back up. This graphic you can see on the screen right now hopefully illustrates the point brilliantly. When markets go up, which is a bull market, they tend to go up for 4.4 years on average. When markets go down, a bear market, that tends to be 11.3 months on average. And if you think these markets at the moment started going down at the end of November, maybe, just maybe, we're only 5 months away from when the market turns and we enter a new bull market. Obviously, we don't have the crystal ball, so we don't know how long that's going to be. And as you can see in history, some are longer than others. But it's definitely worth noting that when markets go down, it's never nowhere near as long as when markets go up. And on that point, across in America, President Biden is considering cutting tariffs on Chinese imports. That will lower US consumer prices. And the US consumer is so key to what goes on in the world. If the US consumer is out spending money, purchasing goods, purchasing services, then the US economy will do well. And if that does well, most other economies around the world will do very well. We've had rising interest rates in the UK. Interest rates got back to 1%. There was talk of the Bank of England trying to raise those to around 2%. Earlier on this week, news came out to say the Bank of England is considering not going as high on that. We saw UK GDP grow by 0.8% in Q1 of 2022. A recession is regarded as 2 negative quarters of GDP growth. So if GDP goes down over the next 2 quarters, it's classed as a recession. And a lot of industry experts are suggesting that we are already entering into recession. So it doesn't have to be a heavy recession, but GDP, i.e. the gross total of what we're spending, the economy is falling. We need some way to pick that back up. As I say, it's Wednesday afternoon now. Apparently, Boris and Rishi Sunak are going to announce a whole range of measures in the next day or so to try and stimulate people spending by reducing the cost of things, trying to help those people who are most hardly affected by the cost of living increases. Why is that being a thing? Well, inflation, as I say, has been roaring ahead. The UK inflation rate rose to over 9% in April, levels not seen since the 1970s. There is a chance that it could be higher again next month or the month after. But governments are hoping that inflation will start to come down towards the end of the year. What they call flexible inflation, i.e. the price of food, goods, energy, that sort of thing. They might be able to bring that down by using some of these measures like what President Biden's doing or what Boris and Rishi Sunak do at the end of the week. But sticky inflation, that inflation that won't go down, are things like pay rises, because once somebody has a pay rise, they tend not to see their salary go down. So that's inflation that will stick in that calculation for at least 12 months. So we're likely to see higher inflation figures, well, for the next 12 months, at least higher than what long-term targets are. You've got to remember the long-term target is 2.5% to 3%. So they're likely to remain above that level and then maybe come down again. But I think markets have priced all that in. Obviously, as you look across into Russia, the war over there is still rumbling on. If you remember at the end of February, Russia had hopes of being able to take over the whole of Ukraine. They were on the borders of Kiev at one point. Now, Russians are celebrating the fact that they've took over a steelworks siege in Mariupol, which has been rumbling on for weeks. That shows you how much it's changed from what the Russians are expecting to do, what they're actually doing. That's obviously causing problems with gas and oil supplies, but the thing to look out for in the second half of this year is how it's going to affect food prices, because the Ukraine produces so much of the world's wheat and they're not going to have a harvest this year. So again, that's a negative thing on inflation, because the price of goods, of food and energy is going to continue to be high. Across in that region, Finland and Sweden have applied to join NATO. That's obviously not making the Russians very happy, and they've reacted by halting all gas exports to Finland. So you can say that kind of thing is going to run on for the rest of the year at least. So from that point of view, as I said, the news out there isn't great, but it's good to see that world leaders like Mr. Biden, Boris and Rishi Sunak are trying to do stuff to make sure those hardest affected will get some kind of relief. And if you can try and bring the price of things down for people who need to buy these goods and services, then that will be good for the economy and continue people spending and hopefully see off a recession. The article I'm showing on the screen now from the Wall Street Journal just last week hopefully provides some confidence to some of you watching this who've seen your funds fall in recent months. Warren Buffett, who's one of the biggest, oldest, famous investors in the US. If you've never heard of him, please Google Warren Buffett. He's classed as the Sage of Omaha. If he lived in your street in the 1960s and you invested $1,000 with him, the chances are you'd be a billionaire right now. He's been a really good investor for so long. Well, his company now has started buying up the market. Last week, the first quarter of 2022, this was announced last week, his investment firm invested $51 billion back into the stock market. What you find over in America, big, huge investors like this who have this money to invest, once one starts and someone copies, the rest of the market will follow. So maybe, just maybe, some stocks in the market are now being viewed as cheap and investors will go back in. And if that is the case, keep an eye on this. Markets might start go up. However, as I say, as with the previous discussion, inflation is still going to be the big problem markets face going forward. So this chart that we can see on the screen right now is just following on from what we were discussing on a couple of market updates over the last few weeks. weeks, where we talked about stocks that have either done really bad or really well over the last 12 months. This chart here shows the worst performing funds on the S&P 500 over the last 52 weeks. And it's no surprise to see that those companies that were doing so well during lockdown, when COVID was really at its height, are doing the worst now. Etsy, for example, online retailer, people aren't buying as much online maybe because they're able to go out and go in shops and such like. PayPal, the way a lot of people will use to purchase goods online, that's down 75%. We mentioned 74%, sorry, we mentioned Netflix there. Surprising one, Under Armour. It seems every sports team you look at the UK at the moment seems to be sponsored by them, but clearly their sales must be right down. Or what may have happened is when the market was going up during 2020, a lot of these stocks might have been overbought and there might have been too much confidence in the future ability of these stocks to earn money in the future. So big investors, as I say, just take their money away and the funds go down. So there's quite some severe drops in a lot of those stocks. And as I say, this just represents why when we're talking to clients right now, it seems it doesn't matter which fund we've got clients' money invested into, there's not many positive outcomes because a lot of things are just being sold off right now. You can think back to the previous chart about bull and bear markets. You would just hope that this is not going to continue on for too long, because a lot of companies will see good revenues, good sales generated in the next few months, the summer months. People get out spending, people take holidays, foreign travel sorts to get back to where it was pre-COVID, then you should see share prices rise. And now the final part of the presentation, where we look at how stock markets have done since the year to date. As you can see, FTSE 100 still the best performing index on there, again buoyed up by the oil and mining companies. BP and Shell obviously in the news quite a bit at the moment. Governments want to do windfall tax on them and such like. Rishi Sunak might be announcing something about that in the next day or so. But the FTSE 100 is only at 1.8% year to date. And if you look at the wild swings it's had there, obviously end of February going into March when Russia invaded Ukraine. But if you look at the MSCI World Index and the S&P, they're both down negative double digits so far this year, both plus 10%. Could they fall even further in the coming weeks? Yes, it's a definite possibility. Never say never. However, as we've seen, when the market was about to go down by 20%, so it became a bear market, big investors have come in and purchased the market and it's cropped up. Warren Buffett putting $51 billion in the first quarter of 2022 may be followed up, and other investors may do the same, so that market may come back up. But we'll definitely just be keeping an eye on it going forward. So having looked at the chart there of how markets have performed year to date, the obvious thing might be to say, well, the S&P and the MSCI World Index are the worst two performers there. Let's take our money out and put it into something better. Now look at this chart where you can show the performance over a 5-year period, and the S&P is still up over 82% over that 5-year period. It wasn't that long ago where it was up over 100%. Again, talking to someone from the Invesco Perpetual seminar I was at a week on Monday, they were saying that there were a lot of big investors out there who would have seen their investment be up over 100% over that period and think, right, with everything going on in the world, let's just take it all off the table. You're talking about billionaire fund managers and hedge funds here, and they're just waiting for an opportunity to go back in. To me, that's more of a gamble, and that's what these guys do, and that's why they are billionaires, so to speak, and they are prepared to risk hundreds of millions of pounds by doing that. From the point of view of managing a steady away pension investment fund, we're clearly not going to be doing that. We're in for the long term, and if we'd been invested for the long term, as I say, there are some pretty good returns you can see there. As ever, if there's anything that you need from Wealth of Advice, please don't hesitate to get in touch at any time. Thank you.